Wouldn't you like to get your IRA earning more money? And wouldn't you like it to take less time? Well, that works for me. I'm going to show you some strategies you can use starting now in your self-directed IRA. These deals blew my mind when I first saw what could happen when you become the bank. Now, what kind of return are you getting in your IRA? Are you happy with it? I'm going to assume you are not happy with your bank CDs. You know, some people call them certificates of disappointment. Well, we all know that banks pay about 1% on CDs, and that's if you shop hard. Money markets might pay a little better, and, well, the stock market's taken a beating lately. Now, some people say a good mutual fund will historically bring in 12%, but, that's historically. I'm over 50. I don't have time for historic returns. You want real returns. You want dependable returns. I know I do. Now, wouldn't a safe, steady, and secure 8% be okay with you? 8%. That's awesome. How about 10%? Maybe 12% or even better. And without the stock market roller coaster. Well, it's all possible when you're the bank, the First National Bank of you. Let me introduce myself. My name is Nancy Conrad, and I have a self-directed IRA account that I've invested in real estate over the past few years. But it wasn't until I started really digging into the business that I saw the power of creating your own mortgage notes. By the way, I'm just an ordinary person, and I'm doing something that anybody can do when they know how. I'm not a financial advisor. I'm not a stockbroker. I'm not a Wall Street guru. I am not trying to sell you a product. My feeling is that a lot of people who are just like me could put some of these ideas to work for themselves and have a more comfortable retirement. So here's what happened to me. My husband and I pulled our money out of the stock market in disgust around 2008. Every penny came out. You remember 2008, right? The housing market blew up. Our house lost half its value. We were in California at the time. And then the stock market shortly thereafter went into a serious nosedive. We eventually stashed our beat-up pile of cash into a self-directed IRA so that we could buy property that was selling at fire sale prices at the time. It seemed like it was the only opportunity around, and it was for us the best direction to take. Now, we picked up our first IRA investment property in late 2009. It was a fairly new 4-bedroom house in a gated pool community in California. I had it cleaned up and I rented it out for the next few years while it gained steadily in value. Every month, like clockwork, the tenant sent me a check and I deposited it into the IRA. It was pretty sweet. We felt like we were in control, but I still had a lot of ground to make up for. So pretty soon, we bought our second property, also a foreclosure, in Phoenix, and then we rented that out, and then another, and then another. So that plan could continue indefinitely since all the rents collect tax-free in the IRAs. But, that's a lot of managing property, isn't it? I mean, am I going to want to manage all this in 10 or 15 years when I'm 70? So let's say you're already doing this like I am. You could be getting anywhere from 7 to 8%, 12% or more on your initial investment. But let's look at what happens to the money that's collecting in your account and not working for you. And more importantly, are you getting all you could from the growing value of the property? Remember, I'm in my 50s. I don't have time for things to grow slow. I don't like slow. I like fast. You should ask my husband about how I drive, but I digress. Okay, let me give you an example. If you bought a property and you put in some money to fix it up for a total of $50,000 and you're netting $500 every month, well, that's $6,000 a year and a return of 12%. Pretty nice, right? But what happens when that property goes up in value to $75,000 and you're still netting $500 a month? Well, that's still a 12% return on your investment, which is great, but it's an 8% return on the value of your property. Well, now it's not quite as great, is it? So I started looking at that, and here's where it gets interesting. Strategy 1. Well, you can sell that $75,000 property and simply cash out. But if you did, you'd need to find a replacement investment with the same kind of cash flow for your account. And it's harder to get a good REO deal from a bank these days. By the way, listen all the way to the end and I will tell you how to solve that problem. So, what if you sold it with seller financing to a buyer and you are the bank? Well, here's how that looks for your IRA. The sale price is $75,000. Your down payment at 10% is $7,500. Your interest rate that you're charging is 7.5%. The term, let's make it 30 years. That's a nice round number that's often used. And the note is going to be written at $67,500. That's how much your borrower owes you. Well, the payment on that is $471.97. Well, that's pretty good. So here's how your investment looks now. You've had a $50,000 initial investment. You've had a $7,500 down payment that went right back into your account. And now you have a total investment value of $42,500. Well, guess what? Your interest rate of return just went up to 13.06% because you're receiving payments of $471.97 on an investment of $42,500. You'll receive interest payments of $127,000 plus your $42,500 for a total of $169,000, well, almost $170,000. Plus, this is the nice part, you're off the hook for upkeep, taxes, and insurance. That means no leaking toilets or roofs to repair. Your borrower will be making his payments to a servicing company who simply mails you a check every month. Boom, that is passive investing. And how cool is this? If your borrower fails to pay, well, you take the property back and you resell it. That is your security in the deal. It's like having an insurance policy. You've created a mortgage note. Now you are the bank. Now, here's another way of doing it. Strategy 2. Let's say you've got a few years before you retire and you don't need the cash right now, but you do want to get into as many investments as you can before you retire. Well, you can sell your property with owner financing, just like in our first example, but then you sell part of the future payments to another investor. This is called a partial. So in this case, we'll have Bob Investor playing a different role. Bob wants 10% on his money without doing any of the work, and he wants the security of real estate. Well, fair enough. You can sell what's called a partial on the note you created. In a partial, you sell any number of the payments, the cash flow, to another investor. In this case, Bob agrees to buy the front half of your $67,500 note for $42,500. Well, here's what that looks like. Your original sale price to your borrower was $75,000. His down payment was $7,500. The interest rate you set it at for your borrower was 7.5%. The term was 30 years, and the note you created was $67,500. Well, let's say Bob buys the partial for $42,500, as we said, and the payment is $471.97. Well, that comes to a solid 10.5% return for Bob. That's a darn decent return. If he pays you $42,500, he gets the next 180 payments, and you are completely bought out from your original investment. You own part of that note, but you don't have any money into it. Well, Bob makes a nice return, and so will you, because after 15 years, if your buyer hasn't sold the property or refinanced, you'll get the note back, and it will still be worth $51,217.67. Well, and then you can keep getting the payments of $471. This is the mailbox money you wanted, right? Meantime, you've taken your money, the cash you got from this sale, you've invested it someplace else, and you're doing something similar. Then you'll just rinse and repeat, building up your cash. Sounds great, right? So I've got one more strategy for you. Strategy 3. Okay, let's say you sell that $75,000 property to another self-directed investor. You finance it once again, but the terms are a little different. Well, this is called the 50-50 deal. I will give complete credit to Eddie Speed and his organization. They are the masters of the note business, and they showed me how to do this. Well, in this case, Bob decides he wants to have a fully paid for property just like you, but he's willing to let the property pay for itself over a period of a few short years. Let's say he pays you 50% now and you finance the rest over 5, 7, 8, 10 years. In this case, we'll use 7 years as an example. Here's how it looks. The down payment to you, $37,500. The note you write on the mortgage is $37,500. The term, we're going to set that at 7 years in this case. The interest rate will be 5.5%, and the payment, $538. Well, that's a pretty good deal for Bob because he'll get the cash flow he's looking for in 7 years. He's now the owner of the property, but you're the bank. His IRA keeps accumulating value on the property as he pays down the debt, and he's collecting rents that keep going up, right? The property value is also likely to go up, and that payment he makes to you is completely covered by the current rent, and it only gets better over the years. Well, what happens to your return? It looks like 5.5% isn't very fair to you, right? Well, let's look at it closely. Here's the real percentage return based on the cash you have in the deal. Well, your investment was $50,000. The cash you received was $37,500. You've got a remaining investment of $12,500, but you're still getting a payment of $538. Well, that's a whopping 50.06 annual return. Holy cow, yeah, I know. How many of those deals would you like in your IRA? Well, if you've gotten this far, congratulations, you go to the head of the class. Most people, well, they just don't get it. But this could change the trajectory of your life moving forward. Oh, and one more thing, if this is something that you would like to do in your IRA, let me know because I might be your Bob. I buy notes, or you could be my Bob and you can pick up one of my 50-50 deals. And I also get access to distressed assets that banks have sold to hedge funds for pennies on the dollar. And I can't buy all of them myself, much as I might like to, but I have to pass some of them along to my contacts and business colleagues, and that might be you. But I'll talk about that in a future video. Till next time, here's to your cushy retirement.